Hey guys, in this video I'm going to go over my top 6 stocks, extremely undervalued and have tremendous growth potential. I've spent the last month and a half analyzing hundreds of stocks, and this is my list of stocks that I think are the best buys right now. So be sure to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow like crazy and why they're extremely undervalued. So let's get started. Once again, my name is John Lee and welcome back to my channel. So the first stock we want to talk about is the Schwab US Large Cap Growth ETF. Stock ticker is SCHG. This really isn't actually a company, but it is an ETF that tracks the stocks of the Dow Jones US Large Cap Growth Total Stock Market Index. So if you guys want me to make a video about my top picks for ETFs 2021, make sure to leave it down in the comment section below, and I just might drop that video very soon. So it covers 235 stocks from companies that are expected to experience higher than average growth, including Apple, Microsoft, Amazon, Facebook. So right now, one share of SCHG is trading for $138.17 with a 52-week low of $95.85 and a 52-week high of $142. This ETF has done really well in the past year, going from just under $100 per share to where it is right now. The fund has net assets over $14.59 billion, an average yield of 0.46%, year-to-date daily total return of 6.87%, and a very low expense rate of 0.04%. That means that for every $10,000 of the stock you buy, you're only spending $4 per year in annual expenses. That, you guys, is extremely good. For an ETF now, if we look at these sector ratings, we can see that SCHG is especially heavy in the consumer cyclical, financial services, healthcare, communication services, and technology. The average PE ratio is 36.26 and the average price to book ratio is 9.47. The top 10 holdings include Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Visa, United Health Group, and Nvidia. So if you like a majority of these companies, then this might be a really great one to buy, just so that you can have a more diversified portfolio. And looking at the performance overview, we have a 1-year daily total return of 37.21% and a 3-year daily total return of 22.49%. For most years, this fund has done extremely well, especially in the last few years where we saw a growth of almost 40 each year. However, we did see a drop both in 2018 as well as in 2011. So if you guys buy a share of SCHG, it's like buying a piece of a ton of different growth stocks. So obviously this video is about stocks that will hopefully make you money, and for those of you who are into high growth but naturally riskier tech stocks, this is a great way to diversify your holdings. I'm huge on index fund investing, and I know that choosing individual companies to invest in can be a hit or a miss. That's why I recommend ETFs for most beginners as well as seasoned investors. When you buy an ETF, you're basically in it for the long run. The reason why I particularly like this ETF is that the expense ratio is so low at 0.04%. This is on par with many of Vanguard's low-cost ETFs that I also recommend. It's just a very cheap and good way to hold a bunch of companies all at once, and since its inception in 2009, it's earned an average annual return of about 16%. Of course, past performance does not guarantee future performance, but it is a good statistics that tells you how strong this fund has performed and hopefully should do well in the coming years as well. So the next stock on my list is L Brand stock. The ticker is LB. This is an American fashion retailer that owns brands like Victoria's Secret, Pink, Bath & Body Works. Right now, L Brands is trading at $65.79 with a 52-week low of $13.18 and a 52-week high of $71.99. Their 1-year price chart shows steady growth all the way from under $20 1 year ago to almost $70 per share today. Their market cap is $19.487 billion with a PE ratio of 13.97. Earnings per share $5 and a very small dividend of 0.33%. They have a 5-year PEG ratio of 0.57 and a price to sales ratio of 1.38. In terms of profitability, L Brands is sitting at a profit margin of 10.73, and the balance sheet shows a total cash of $3.9 billion. Now, analysts are a little bit mixed on this one, and they've rated it as a 2.5, meaning it is between a buy and a hold, but the average price target is $77.10, which is about $10 higher than the current price of $65.79. So the L Brands quarter 1 year fiscal 2021 earnings actually beat analyst estimates, hitting an earnings per share of 1.25 and revenues of $3.02 billion. Net income also rose $276.6 million, and total sales were up 80 from $1.65 billion a year earlier. This was fueled by momentum across its three main brands and people paying full price for more and more items later this year. L Brands is actually going to spinning off Victoria's Secret into its own publicly traded company. It plans to do this so that they can maximize management focus and hopefully deliver more profits. I do think that existing shareholders should likely benefit from this tax-free spin-off. As an existing investor, you would also receive shares of this new entity. So yes, the price of L Brands theoretically will drop, but that drop will also be made up in the new shares of the new stock that you will receive. And additionally, for Victoria's Secret, they have seen huge increases in sales for its lingerie line, and as a result of a more inclusive marketing approach that targets women of all sizes, I do think that this is a smart move for the business as it unlocks a lot of new untapped markets that they really didn't have much business in before. And with Bath & Body Works today, they've seen an increase in sales with more and more people getting into at-home and personal care products. Overall, I do think that L Brands is a good stock if you want to hold long-term. And in the short term, I do think that we could see it drop. So if you see that the dip might be a good time to pick up some more shares. Either way, I do think that L Brands can beat up the competition and remain a strong company for the next decade or longer. Okay, the next stock on my list is Intel, stock ticker INTC. This is an American technology company that is actually the largest semiconductor chip manufacturer by revenue. Chances are you currently use an Intel processor right now on your computer. So right now Intel is trading at $57 with a 52-week low of $43.61 and a 52-week high of $68.49. In the recent years, Intel actually has been pretty volatile, and you can see that 1 year ago they started off over $60 per share, dropped pretty significantly at the end of last year, recovered until the month of April, and then saw a pretty significant correction. Intel has a market cap of $230.651 billion, a pretty low PE ratio of $12.79 with an earnings per share of $4.46. And they do pay out a dividend of $2.43. Their 5-year PEG ratio is sitting at 2.34, and they now have a price to book ratio of 2.88. Now looking at its profitability, we can see a profit margin of 23.93% and a very good return of equity of 23.82. They're sitting on about $22.4 billion in cash, and they have a very strong current ratio of 1.89. This means that they have 1.89 times the current asset as current liabilities. Now analysts are also a little bit mixed on this one, and they're rating it as a 2.8, meaning it is around a hold, but the average analyst price target is $64.87, which is well above the current price of $57. So Intel is much more low-key than companies like Nvidia and AMD, which means a P ratio is much lower. I personally do think that Intel is rather undervalued, especially when you compare it to its competition. Sure, Intel has not come out with anything drastically cool in the recent years, but as a result, much fewer people talk about them, but that also means that the prices are not hiked to the moon by retail investors, which means that right now it could be a good time to pick up some of these really low PE ratios. And right now Intel is getting smoked by Apple, which by the way is also another stock I recommend. But I do feel like Intel will fire back. At some point they definitely need to reinvent their chip architecture and come up with something that competes with Apple's new M series chips. But in the past, Intel has been remarkably resilient and consistent. In fact, they've beat analyst estimates 11 of the 12 quarters. And like I mentioned before, they're paying about 2.5% annually with a really low payout ratio of just 30, which means that a bulk of the money is being invested into its own research and operations. I do think that competitors like AMD might see bigger swings in the share prices, at least compared to Intel. So if you want to ride those waves, then maybe those are more exciting stocks for you. However, Intel will be a long-term hold that pays out a nice little dividend grows with time and builds you slow long-term wealth. That's my prediction, and that's why I include Intel on this list of top stocks that are undervalued. Now, the fourth stock on my list is Bank of America, stock ticker BAC. This is an American financial services and banking company. Chances are, if you're an American citizen, you bank with them at some point in your life. And they're the second largest bank with a total asset of $2,819 billion of US, and right now the share for Bank of America is trading at $42.88 with a 52-week low of $22.39 and a 52-week high of $43.49. Looking at a one-year price chart, we can see that Bank of America was trading around $25 a share 1 year ago, starting in June of 2020. That's when their prices really began to shoot up. It's a huge company with a market cap of $363.253 billion and actually pretty decent P/E ratio of 18.40. With an earnings per share of $2.33, they pay out a dividend yield of 1.7%. Their 5-year expected price to earnings growth rate is sitting at 1.57, and they have a price to book ratio of 1.48. Bank of America has a pretty healthy profit margin at 25.65% and a return of equity of 8.94%. Now, if you aren't sure what any of these metrics mean and you want me to explain it in another video, let me know below in the comment section, and I will make a video to go over stock terms and how to invest in the stock market as a beginner. Now, back to Bank of America's balance sheet, we can see that they have a total cash of $803.34 billion, as well as total debts of $542.46 billion. It's always interesting to see what analysts have to say on a scale of 1 to 5. 1 being a strong buy and 5 being sell. Analysts are currently rating Bank of America as a 2.2, meaning it is between a buy and a hold, and the average analyst price target is 43.45, which is just a little bit over the current price of 42.88. In the last year, Bank of America has performed quite well in comparison to its peers like Citigroup, JP Morgan, and Chase. I've been a long-term believer in investors in Bank of America, and the returns have definitely paid off. Right now, Bank of America is not an undervalued stock. Rather, I do think that it is priced pretty appropriately. So in the short term, there's no saying where the stock will go. And in terms of price, however, I do think that as they continue getting market share in the US banking sector, the price should see long-term increase. Right now, Bank of America has about 12.6 national deposit shares, which beats JP Morgan as well as Wells Fargo, and they actually set their goals on 25 as their long-term goal. The thing about a giant bank like Bank of America is that they can leverage their size to their advantage. For quarter 1 of fiscal year 2021, Bank of America has total revenues of $22.8 billion, which is just a bit higher than the year before. Its investment banking revenues were up significantly, while its consumer banking division saw a drop due to lower interest rates. On its next earnings report, investors are expecting earnings of 75 cents per share, which will represent year-over-year growth of 102.7. So yes, this is a boring company, but if your portfolio is missing some of these boring giants that are, in my opinion, much safer long-term investments, then I would consider doing some more research and adding some of these Bank of America stocks to your portfolio. Number 5 on my list is Alphabet, stock ticker GOOGL. This is an American company also known as Google, and it is the parent company for one of the most prominent search engines in the world. Alphabet includes other subsidiaries like Waymo, Google, Fiber, Fitbit, and more. So right now, one share of Alphabet is trading at $2,482.85 with a 52-week low of $1,341 and 52-week high of $2,494.50. Don't let the high prices scare you, because you can actually invest in partial shares on platforms such as Robinhood. In the past year, you can see that Alphabet has done extremely well, and it really has not seen many corrections at all. Alphabet is extremely big with a market cap of $1.597 trillion. They have a P ratio of 33.09 and the earnings per share of 75.04 cents. Their 5-year PEG ratio is 1.27, and they have a price to book ratio of 7.24. They also are doing really well with their profitability with a profit margin of 26.12, and they also have a really good return on equity of 23.69. Looking at their balance sheet, we see that they have a total cash of about $135.1 billion and a very, very strong current price ratio of 3.1. Analysts absolutely love Alphabet and they're rating it as a 1.7, meaning it is between a buy and a strong buy. And the average analyst price target is 2625, which is about 15% higher than the current price of 2482.8. And it's very important to know that Alphabet has two ticker symbols, GOOG and GOOGL. GOOG is the Class C shares with no voting rights. Google shares are Class A shares with voting rights, and hence they trade for a little bit more money. It really doesn't matter, in my opinion, which one you get, as both will see the same gains. So that's amazing because Alphabet's earnings per share is expected to grow 50 this year, which just shows how big of a cash cow they are. Investors love its big profit margin and history of fast sales growth and cash flow, and their balance sheet is also insane. The staggering $135 billion in cash. Recently, we have seen Alphabet starting to buy back shares, $11.4 billion in stocks last quarter to be exact, which is a great thing for investors as it reduces supply available and drives up the price. I'm 100% dead set on Alphabet as a long-term play, but it's only because I personally believe in all of their products. For example, YouTube is a big part of their company, and I do believe that they will revolutionize the content and media consumption. Alphabet's recent earnings report showed big growth with revenue up $34 to $55 billion, which was from YouTube and Google Cloud. It's certainly not a cheap or undervalued stock right now, but you can actually use the platform to purchase partial shares like I mentioned earlier. Overall, I think the Alphabet will expand and grow its current business greatly in the next decade and beyond. We just have businesses that are too powerful and too in line with what I have both in convictions in for the future. That is why I'll be continuously investing in them. That's why I'll be continuously investing in Alphabet for as long as I can. Okay, the last stock on my list is Coinbase, stock ticker COIN, COIN. This is an American cryptocurrency exchange platform that brought in $1.14 billion in revenue in 2020, and it's perhaps the most popular cryptocurrency exchange in the world. Chances are, if you trade crypto, then you've used Coinbase before. So right now, one share of Coinbase is trading at $220.66. The 52-week low of 208 and 52-week high of 429.54 cents. Coinbase actually IPO'd on April 14th, 2021, and since then we've seen the price dramatically fall. The current price market cap is $61.95 billion, and we don't have any information about the P/E ratio or earnings per share. However, we can see that they have a price to book ratio of 21.42, a profit margin of 36.8, and a really great return equity of 54.2. They're carrying about $1.98 billion in total cash. They have a pretty good current ratio of 1.2. There really is not too much information from analysts at this point about Coinbase, but right now they are rating it as a 2, meaning it is a buy, and the average analyst price target is $395.64, which is getting close to double its current price of $220.66. Now, a stock like Coinbase is risky because 90% of its revenue is currently tied in transaction fees, and those fees can take a big hit when crypto sees a decline in prices. Really, I don't suggest considering this stock if you're a real believer in crypto for the long term. I expect huge variances in price for Coinbase going both up as well as down, and this is sort of going to mimic the volatility of crypto itself. Long term, if crypto becomes even more mainstream, then I see Coinbase being a really great long-term hold. The recent IPO on April 14th saw prices rise from $250 all the way to the low 400s before closing its first day at $328 per share. Now that Coinbase is trading in the low 200s, obviously we did see a big drop in prices. I'm going to start dollar cost averaging the stock as I feel like its price is close to a new buy point. And recently JP Morgan gave Coinbase a price target of $371, which caused prices to surge almost 10%, as its Q1 earnings slightly missed estimates with a total revenue of $1.8 billion and earnings per share of $3.05 for 2021. Coinbase estimates that they will end the year with about 56 million users and $223 billion in assets on the platform, which would be 11.3% of the crypto market. I do think that as more and more platforms introduce crypto trading, Coinbase will be forced to lower its fees to remain competitive. Right now, almost all beginners start on Coinbase, and that's partially due to the fact that they have a great referral program that incentivizes a lot of signups. So yeah, I really do like the strong marketing efforts. Overall, I do see fees dropping at some point to remain competitive, but if the overall crypto market grows in the next decade or more, this will not matter. I repeat, only consider stock if you're in on crypto and you think it will do well. I personally do believe in crypto and have a significant portion of my portfolio in actual crypto holdings, and that's why I'm a long-term believer in Coinbase stock. So those are my top picks for the month of June, especially stocks that are currently underrated, undervalued, and have tremendous growth potential. Like I always say, before you invest in anything, especially stocks, you need to do your own due diligence. Do not buy any stock just because it was on the list. Rather, you should use this video as a starting point, do your own further research for each of these companies if they interest you, and then make your own decision whether or not you want to buy that stock. Like I mentioned earlier, if you want a whole rundown on how to invest stocks for beginners, let me know in the comment section down below. Or if you want me to create other videos around investing, maybe more on ETFs, drop them in the comment section down below. If you have any questions as well, drop them down below. I'll definitely get back to each and every one of you. Anyways, happy trading, and if you guys like this video, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content around personal finance, investing, entrepreneurship, and on Tesla. Thank you so much for your time, and as always, I'll see you in the next one.